Hello traders, this is Fawad Razak, market analyst for City Index. Today is the 1st of February 2024. So I'm going to have a look at a few major US indices following the FOMC inspired sell-off that we saw on Wednesday. Now today the markets have bounced back, not just in the US but in Europe as well. However, the indices are now testing some key levels, which may prevent the markets from rising further. Although we do have some key earnings results coming up today as well from the likes of Apple and so on. So that's a key risk to consider when trading US markets today. Now, the Dow created a large bearish engulfing candle yesterday. This is a potential reversal pattern. We are yet to see a lower low form, but judging by this candle alone, it could be a potential topping pattern, although we have seen another one over here which didn't lead to any downside follow-through. So what we need to see this time is some downside follow-through, and the key level to watch in terms of resistance is right here, the low from Tuesday's range at 38,240-ish, which is being tested at the time of this recording. So the area around here needs to hold if we are to see some downside action around this area. On the downside, support, there are lots of support levels, obviously, because the market has been trending higher. So let's see where the first level of support is. The first level of support is not very far, around this area here, at around 38,000. I call it 38,050 or so. It's not obviously exact science, but somewhere around there. Below that, we have the 21-day exponential moving average and these highs from before, which gave way on the 19th of January before the market came back down to retest that level before pushing higher. So that area is the next downside target. And then below that, there is the head of this candle, which has not been retested on the daily time frame at 37,000. That's quite far from where we are at the moment. But let's see if the markets will sell off and get to any of these levels, because obviously the trend is quite bullish, and we need to see a breakdown of market structure of higher highs and higher lows before we turn bearish. All right, let's look at some other indices, starting with the S&P 500. Well, the S&P 500 created an all-time high as well earlier this week. But interestingly, it has topped, at least for now, at around the 161.8% Fibonacci extension level of the downswing that we saw from July of last year that ended in October. So the market has extended to the 161.8% extension of that move, which means that obviously the market was severely overbought at that point, and some profit taking was always likely. We saw some profit taking around the 127.2% extension previously, and now we are seeing some around that 161 extension. So this should have been expected to some degree. Whether or not it will lead to anything significant remains to be seen. Again, it's a similar picture as the Dow. We need to see a breakdown of some key support areas before we turn bearish on this market. But recent price action has been quite bearish in the last couple of days. So let's see if we'll get any downside follow through. In terms of resistance levels to watch on the S&P, this level right here at 48,075 was the low of this. Let me just zoom in a little bit so you can see it clearly. This level was the low from Monday's range. We broke through it. Now the index is coming up to retest it from underneath, and so far it's holding below. So so far it's looking like the bears are in control of price action, and from here the market could drop to test liquidity that would be resting below the low of yesterday's range, this level right here, at 48.42. So people who have bought the dip, undoubtedly some of those guys will have their stops placed some distance below the low of that candle, and that represents an area of liquidity for the market to reach. So I think that's where the market's headed. Below that, we have this large shaded blue area where the market may find some significant support, because this area is where the previous all-time highs had been created. The 2022 high was where is it? Over here. That was the January 2022 high, and the December peak of last year was at 47.95. So you can refine this a little bit further, like this. Around there is where I'd expect to see a bounce of some sort. But if it doesn't bounce and it goes through there, then the next downside target for me would be the high of this candle that was taken out on the 18th of January at 47.68. So that level is the next downside objective for me. Now, if you get anything anywhere below that level, ideally on daily closing basis from a bearish point of view, then that would be quite bearish, and it could lead to a sharper correction as more support levels give way. Finally, let's look at the Nasdaq. And the Nasdaq is looking, it's kind of displaying this similar picture as the other indices. This one has a bullish trend line that needs to be defended, where we also have the 21-day exponential moving average coming into play. But the breakdown below some of these levels that I had highlighted previously is bearish in the short-term outlook anyway. And similar to the S&P 500, this shaded blue area is where the bulls will need to step up if they want to keep this bullish trend intact. Failure to do so, and if we get a break below the 17th of January low at 16,560, below that level, I think the path of least resistance will be to the downside. For more analysis like this, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.